going to talk about trading the gap with chart psychology. Let's get moving. We don't have much time. All right, a little bit about myself. Back around 1980 or so, I thought to myself, how do you trade stocks? Probably knew less than majority of you that are in the room today. Educated myself, by the way of trial and error. It was expensive. There was no internet. It was a bit of a tough road, of course. Years later, I founded what's known today as Pristine, the Old Method, back in 1994. I've done live trading challenges at the trading expos over the years, wrote several books, and backed off for a little while, took some time off. But over those years, I've educated, this is hedge fund managers, market makers, every different type of trader, prop trader, institutional trader, retail traders, and of course, investors. A lot of my students educate today. If you go to my site, Master Trader, and look through the About Us, you will probably be pretty surprised to see how many of the education firms that you know today are actually my students from years ago and got into the education business. But today I continue to educate. Having gone through, educating myself and trying many different methods, which was of a benefit long term to find out what doesn't work, what's subjective, how to simplify things. And, education industry today is built on primarily on indicators and proprietary software, and it's just unnecessary to go that route if you understand how to utilize simple price action. This was me, it was about 20 years ago. I think that was 1999 at the first Traders Expo at our booth that we had teaching trading, training, and technology that we called the 3 T's in the market at the time. We did a lot of expos over the years. Eventually, they kind of were taken over by the brokerage firms that were telling everybody back in 1999, stay away from the day trading, you're going to lose all your money. And today, that's all they do is try and bring on day traders and active traders, of course. You can get a lot of great information at our YouTube channel. There's the address right there. You can probably go to YouTube and just type Master Trader. A lot of videos there that my partner and I do, a lot of great education. So I know, you're here, so you're looking to find out what works in the market. So, there's many videos there. You can see a lot of them are 5 minutes, 8 minutes. Some of them are, an hour or longer, but there's a lot of information there that you can go through and pick up a lot of great information. So my approach to reading charts and price action is about, tell me what other traders think. When we say proper trading is proper thinking, but how do you know what to think? So what are others thinking? That is displayed in the footprints of money that's on the chart. It forms price patterns. And that's what pattern recognition is. It's recurring arrangement of price bars. And this is what suggests what's going to happen in the future. This is what we look at charts for. Right? We're all looking at charts, trying to figure out what is the direction of prices. Well, they can only go up, down, or sideways, but they can do that in many different time frames. And that is what creates confusion for the majority, is trying to figure out how to put together multiple time frames and come to a conclusion as to the probability of the direction of prices. So these patterns, they communicate to us how traders have acted. What are their beliefs? As prices pull back to an area called price support, it's going to form a picture, and it's going to tell us whether buyers are taking control, whether there's strong demand there, or whether there isn't, and sellers are still in control. And we determine that, again, in multiple time frames to put the odds in our favor as to what's going to happen in the moment. So these candles provide us a picture of those expectations on an ongoing basis. I can coin the term candle language because It communicates to us how to read candles. It's not about remembering the names of dark cloud covers and morning stars and piercing patterns that all are supposed to suggest the direction of prices or the potency of a reversal. The potency of a reversal is dependent on multiple time frames and the location and trend within that reversal. And so we need to put that together to put the odds in our favor. To just say that there's a particular pattern and that is telling us the direction of prices is misleading. But here's a real simple example of what I'm talking about. And if you put yourself into the position of this guy with his hair going up and thinking if you had bought this particular instrument, it doesn't matter what it is, a stock, a commodity, a currency, and you had bought above the high of the little red candle, think about how you felt at the high of the big green candle. Depending on your share size or contract size, you got money there and you're thinking, this is great. It's going in the direction that I believed it did. At the end of the second candle, your confidence is probably out the window. Your ego's deflated. What has happened here? What should I do? And so you can see the psychology behind just these few candles and how they can shift your thinking and beliefs about what's happening. So as we put this together in the context of trends and multiple time frames, support and resistance, we're really getting somewhere in the probability of determining the direction of prices. And this is what I refer to as a shock pattern. So these shock patterns that occur in alignment with what we're looking for are extremely powerful. Now, gaps come in a couple of different types. Now, we could talk about exhaustion gaps, continuation gaps, but what we're really interested in is what I would call a professional gap. And that is the type of a gap that says, go with this. Now you can see the way that I've arranged these candles. And you can see it's an arrangement that I've actually put together where prices have pushed up and then the candles began to narrow, which tells us that momentum has stalled. Now that one with the tail on the top with the TT, which means topping tail, and the BOF, which stands for a breakout failure, tells us that there was a shock that occurred there. Now think about what that candle, that last candle, what did it look like before it completed the time frame that it was at? What did it look like and what were traders thinking? So you see, as it was moving up, obviously it had to be a big green candle. Traders were thinking, that bought the breakout, I got this one nailed. It's going in the direction that I believed it should have. But by the time that candle completed itself, their confidence is shaken. They're thinking about, what do I do now? Should I cut this thing loose? Now, as we put this together within the context of a trend, and in this case, if it was an area of resistance, I've got a high probability trade here. Now, it gaps down below that topping tail bar. I've got a great gap to look at this from an intraday point of view to short that. Maybe within the first 5 minutes of the open, we have to see the pattern that develops at that time. So we're going to give it some time. We've got patterns that we look at, the time frames that we're going to look at to determine our action in the morning. The other type of gap is a novice gap, the type that says, it's probably the type of gap that we should fade. And you see the way these candles have formed is that the ranges are expanding. So a wide range candle after multiple candles moving in one direction suggests the end of a move. So again, we look at this from the point of view of traders' thoughts. So as prices start to go down, think about this from the perspective of being in a trade that you should have taken your stop on, and it's going against you, and you're watching this and you're seeing the P&L red and your loss is growing, and you're looking at different points on the chart as to where this stock, commodity, whatever you're trading, is going to turn around, and it just keeps going down. And you are at that moment where it's like, this thing is never going to go up. I can't handle this loss. And this is where the majorities, their feelings come together at that point, and the range expands, and then it gaps down. And that exhausts the selling. They puked it. They said, I couldn't take it anymore. This is a dog. And they sell. And now we go to our intraday time frame and we look for bottoming type of patterns that suggest that prices are going to go up. Right? So each morning we scan for what's gapping up and what's gapping down. So we look for the professional gaps to go with and the novice gaps to fade. Now, I'll tell you that the majority of the gaps that we do are of the type of professional gaps, even when the gaps are relatively big. Unlike futures, which, let's just say the psychology of E-mini equity futures traders are to fade gaps, the majority of stocks, which are affected by earnings or news, are to go with. And you might be surprised the extent of how much a stock will move even after a relatively large percentage gap, 10%, 15%, and they keep going down. After they may take 5 minutes to trade, whatever, each day can be different, but we have to put together a set of rules how to handle that and the patterns. So here's some examples of what we're looking for. So on the right there where it says professional gap, we would love that, meaning because it's just gapping above the resistance area where it was going sideways. So it is just cleared the resistance, and it's got what I call a void above. Void meaning that the way it came down, let's get a little pointer here. The way this came down with this type of momentum, there's no reference point of resistance here. There's just a fluid movement to the downside. Then as it went sideways, it starts to build some support. And certainly it could have dropped and went lower, but notice this red candle here and then the reversal. So it tried to go down, which tells me that somebody shorted this, and thinking rightly so, I would say, because of this drop, but it failed and then it gapped up. Put yourself in this guy's trade. What are you going to do? You're going to cover. And especially if you're an institutional type of trader and you held this overnight, and let's say you've got 10,000 shares or 5,000 shares, or you're a hedge fund, right? You're going to feel the pain. And that's what we're looking for. We're looking for pain and how to take advantage of that. With this gap down, it's like a waterfall decline. And look at the wide range bar. And then it begins to stabilize and then gaps and reverses. We go to our intraday charts. Mine is the 5-minute time frame, and I look for, and I don't know what this looked like at the time, but maybe an initial drop and immediately reversal right back to the upside. And that I'm looking for that type of a shock intraday as well, and then a reversal, right? Pro gap up after a pullback, and then a novice gap down. Let's move it along here. All right, so I put together 7 points, gap criteria to rate. This one is just absolutely phenomenal. To this one probably is a pass. All right, so but we need to put together a systematic process to do this. So we rate them. Is the stock gapping above or below support or resistance? If it's gapping inside of that, it's a pass. I'm not even going to consider it. Was there a shock in the last day or two? Like that last chart that we looked at. Did it attempt to go down and then reverse back up again where traders got caught? Did it break out or break down above a consolidation? That was the beginning of that prior chart that we looked at. Is the next reference point of support or resistance nearby, or is there a void? We're looking for the void because now there's no reference point for other traders to sell into. If there's a chop, a congestion nearby, we're not interested. We're looking for the best. Does it have relative strength or weakness to the broader markets? Meaning, are the markets gapping down and this is gapping up or vice versa? Is it ideal? Right? Is it a gigantic gap? Maybe it's a buyout, for example, where the gap is so big, it's like, let's just move on and look for other gaps. And we have to look at the intraday price structure. Does it support the gap? Meaning, if yesterday was a green bar, did it go sideways at the end of the day and then gap up above that? Or did it go up for the last 2 hours of the day and then gap up? Because as an intraday trader, I want to buy something that has already moved up, say 10 bars in a row, if I'm going to go long. So I want to look at the intraday time frame the same way I would look at a daily time frame, but I want to put that all together. So we don't need all 7 criteria to trade the gap, but the more that we have, the better. This is what I look for in the morning. I look at in the morning that scans for gaps. And it's gapping for stocks, the percentage that they're gapping. Does it stay above the opening price or below it? Is it gapping above a green bar, below a red bar, and so on, or I should say in reverse of that. I'm looking for, is it gapping below a green bar? In other words, was it this one on the bottom right here? If is it a wide range green bar and then gapping below it, odds are it's going to go down. And then I look for an intraday pattern. So First Solar, that was gapping down today, you could see it in the list, was a 3% gap. That continued to go down, but it was down several days in a row. It's actually one that I passed on. But this gives us a starting point to start going through these scans. Now I look for patterns, primarily on the 5-minute chart. If it's a 7-point gap, I'll look at a 2-minute chart. But these are the patterns that we're looking for. Typical buy setup, a red bar ignored, meaning it attempted to go down, but I'm thinking long, so that red bar should be ignored. Shock type of pattern, breakdown failure, a failed buy setup or sell setup, condensed. If you put these things together, it could look like one candle. So all of these patterns, we don't know the pattern that's going to form on any particular day. So it's like a toolbox that however this forms, I know what it means, and I've got to put it in the context of my method. So here's an example, right? Gapping above, slightly above this area here. Right? So it was going sideways. It was going sideways at the end of the day. It gaps above, and here is a pullback. Right? Technical analysis 101. You see there's no indicators here. It's just pulling back into an area of support where buyers should show up, and it begins to reverse. So you buy it above the high of the green bar, and you go long and manage it accordingly. And so we look at, again, relative strength, weakness. Is it gapping above the base or consolidation? Is that a price void? All of these criteria coming together puts the odds in our favor. So here's one from last week that we did in our chat room that we call the green room. Now I call this above the high of this little consolidation here. The first 5-minute bar is high. There was a bottoming tail bar, and then it traded above. And that was our entry, as it points out right there. But once that happened, there was a topping tail bar. And I say, oh no, this is not what's supposed to happen as it breaks out above the highs. But we have to share size it accordingly and not put a stop just below a prior bar's low, because especially in this market, we're going to get chopped up. And this is where I sold it. I told the room, why sell it there? Am I clairvoyant to sell it at the high of that big green bar? No, it's just a wide range bar that came after multiple bars moving up. And you see it did go higher, but I said sell it. As a gap type of trade, it was a great trade. The entry was excellent, had to sit through a little bit of uncertainty. And as it went up, it was what I call a painless trade. And then when I saw the wide range bar, I said, let's take the money. This is actually MGM, and actually it moved lower, but on this day, it was a good gap trade. Notice the base and everything was coming together. I say, get rid of the indicators. You don't need to put a bunch of squiggly lines on your chart. This was another trade that was actually the next day, was Box. I don't know whether they reported earnings. I forget what it was. There was something in the news, but it was gapping down. This was the daily chart. There was a bottoming tail bar, which was like a little shakeout, and then it tried to move up. And this was the 60-minute chart at the time. And it opened down here, a pro gap, and it opened right down near the bottom of this bottoming tail bar, leaving this consolidation, which was created by buyers expecting it to go higher. I wouldn't disagree with that at the time, but when it gapped down, I knew they were caught. So that was trouble. So it gapped down, there was a shock, it cleared support, there was a void below. We call them the greenies because it's the green room. Actually, one of the ladies in there actually coined that, to call them all greenies. It was great and fitting, of course. And I said, this was our target area down there. I said, why? Why was it a target area? There's nothing on the chart there. No moving averages. There's no fib lines. We don't use squiggly line, fib lines and stuff as support or resistance. It was just overlapping bars in that area. And that was just a logical point where prices would go down to. I hope they would go down to. If the trade is working out, we have to have a target, we have to have a stop, and we have to have management. So what happened? So here I'm looking at the pre-market activity, and it's going sideways over here. So I said, just like we'd look at a breakdown, I said, short it under the pre-market low here. And what happened? I said, let's short that under this base. And initially it went up, which was okay because I was going to short it under the low. And if it went up and it kept going up, I do nothing. So it went up first, which was perfect, and then went down, because this little shock that happens, it increases the odds that I'm not going to get shooken out by some erratic type of movement, which there's a lot of that in this market with these algorithms. There's a lot of erratic whips. So we have to play things wider, but when there's a shock involved, the whip has already happened. So the odds of it happening again are less likely. So I call it, we got you there, right? They're caught. The ones that were going long because of the gap down, thinking, oh, let's fade the gap, but that wasn't one to fade, they're caught. So I was like, this is perfect. What happened? It started going down, and we just held. Right? This likely to continue to go lower. We're in management mode at that point. Now, as it continued to go down at 10 o'clock, that is a reversal period that has happened consistently over the years, but it was still being sold. Now, I don't know if anybody from our green room is here, and they can't type to you, but they would attest to exactly what happened on that day. When this dropped into that green zone that I said, the area, it happened so fast. And if you see the size of these candles as they were moving down, those bodies are about equal in size. What happened in that moment was there was this giant candle relative to the others. And to me, that was an immediate buy to cover. And we didn't get it exactly at the low. It just happened really fast, but it worked out as a great trade from the entry to the exit. I wish they all worked that way. They don't, but this was a great one. So on that flush to the downside, right? And I'm speaking in the room. Sometimes we're typing in the room. I said, buy the cover here. Now, in our room, we do more than day trading. We do options. We do swing trades. We do day trades. We trade ETFs. We're a very versatile room, meaning we don't just trade gaps. We do, as I said, swings, day trade, lots of option trades, probably more option trades. My partner Dan is primarily just an options trader and trading all different spreads and such. So great educator as far as that goes. But where I'm primarily trading the underlying ETFs, stocks, and day trades. Let's see. We have a greenie in here. How you doing? All right. So if you want to learn about trading gaps, right, by the way, when I said if you go to the site and look at about us and you see all of the students that own education firms, work for education firms, that learned gaps from myself. I mean, they are selling gap courses anywhere from $1,000 to $5,000. So more power to them. If they can get it, that's fine. But many of my students are educators, prop traders, and it is what it is. Over the years, I've created my own competition. I said they learned it from myself. But if you want to take the course, go to mastertrader.com. You'll see the gap course under education. And if you type in that code, MTS Gap 2008, the price will change to $495. And with the course, you also, if you use TC 2000, I will send you that page with all of the scans and code to set that all up, so you can set it up on your own system and find those gaps in the morning.